Welcome everybody to this video dedicated to residential mortgage-backed securities, or RMBSs. If you're not a subscriber to the channel yet and you like this video, please do subscribe and perhaps even join the channel as a supporting member, which will give you access to a much wider range of CFA related videos. Okay, let's get cracking with the content. Your curriculum makes a big song and dance about RMBS. You need to know quite a few things about these types of securities, and there are going to be two types that we're going to discuss. First of all, mortgage pass-through securities, which are relatively simple, and they provide the building block for a more sophisticated and complex structure known as the CMO. This stands for Collateralized Mortgage Obligations, which are built on mortgage pass-through securities. So let's start with those building block elements first. The name is mortgage. I got that one wrong. Mortgage pass-through securities. Okay, and this is a very simple, or relatively simple type of structure. Is as simple as mortgage-backed securities get. So we're going to draw over here a lender. Let's say this is a bank that gives mortgage loans, and they provide, let's say they make lots of mortgage loans to different borrowers. So this is borrower number one, borrower number two, and so on. You kind of get the picture. And because they are mortgage loans, they're going to have houses in the background as well, so properties for the different borrowers. These mortgage loans, there could be a few, there could be tens, there could be hundreds or thousands of these, right? These mortgage loans comprise what is known as the mortgage pool, and they are going to act as the backing, as the collateral for a mortgage-backed security, the most basic one being the mortgage pass-through. Now, due to the fact that they have been used as collateral or as backing in such a structure, we would say that these mortgage loans have been securitized. In an earlier video, I talked about securitization as being the sort of the fancy name, the sophisticated name for forming asset-backed securities. Right, so they get pooled together, these mortgage loans, into what's known as a mortgage pool. Now, as we discussed before, those assets are sold, obviously, by the lender, by the originator over here, to a special purpose entity, and it's that special purpose entity that subsequently issues pass-through securities, or any type of mortgage-backed security. Pass-through securities, because they're based on mortgages, we'll call them mortgage pass-through securities, and these get acquired by investors. Investors, of course, pay money for this, and this is how the SB is able to pay the bank, the lender, for the mortgage pool that they've bought from them. Now, the whole idea is that now, obviously, these borrowers who are at the top in my little structure here, I'll just collectively label them as borrowers, will be making, or they should be making, regular scheduled monthly payments. Of course, it doesn't always go to schedule, as we discussed in the previous video on the features and characteristics of mortgage loans. Sometimes you experience delinquencies in terms of how people pay on their loans. These are residential mortgage loans, so we are talking about basically a pool of people who may, for various reasons, for example, income related, be late, but a lot of the time these people also pay ahead of schedule early. This is what we call prepayments, and we'll obviously be mentioning those as well, even though it's been a big topic thus far already. Now, these monthly payments comprise two things. People pay interest on their loans, of course, but they also make principal repayments. These are repayments of the actual capital on the loan, and that principal comes in two, let's say, forms. It's either the scheduled amounts, but also what we describe as prepayments that are very critical to our analysis. Now let's say these borrowers pay interest at 3.85%, at least on average, because in reality every borrower will have their own specific mortgage rate, which is going to be a function of their circumstances, including their credit quality, their credit score, their loan-to-value ratios, etc., etc. Now, all of this gets typically collected by the bank, even though the bank has sold the loans. That's the lender, right? They've sold the loans to an SPE. They still act as the servicer on these loans. This isn't really discussed in depth in the curriculum, but I just want you to be aware of the fact that the bank is typically still acting as the servicer of the loan. So they collect payments, they reconcile them. If anybody's late, they send them a notice, a notification, a reminder, a prompt to make the payment. If somebody's got questions about their loan, they act as the information provider. Anything loan related, they'll still be taken care of as a servicer, but they are no longer the legal owner of the loans. So the bank collects the payments, or the servicer collects the payments, but passes them on, or passes them to the SPE, which then kind of passes them through to the investors over here in a sort of very pro rata proportionate way. If you're an investor that holds 2 pass-through securities, you'll get double the amount of cash flow as somebody who just has 1 pass-through security. That's what we mean by pass-through securities. It's a simple mechanism for pushing down the payments, the monthly payments that come from the borrowers all the way down to the investors via sometimes a slightly awkward structure, but nevertheless we're pushing things down. However, it's not that the whole amount gets pushed through. The entities who stand in the middle, sort of in between, the borrowers and the investors, do collect something for themselves, or do snatch a bit of that money for themselves. And what ultimately goes to the investors, so down here, is also done on a monthly basis, and it's composed of interest, or perhaps the coupon, because they've got fixed income securities, so you'll expect to get a coupon on them, right? And principal as well. Okay, let me move this up. And this principal will once again be composed of the scheduled element plus potential prepayments made by the borrower. Now, the key to appreciate this is what happens to the interest. These guys, the investors, will not get the same 3.85, which the people at the top are paying. They will receive less. They receive something known as the pass-through rate. And let's say this is, for example, 3%. So if the borrowers up here are paying on average 3.85% mortgage rate on their mortgage loans, the guys at the bottom are receiving 3%. I made these numbers up. Actually, I didn't make them up. I based them on a real pass-through security that I looked at before recording this video. So that difference, that 0.85 gap here, 0.85% difference, is actually known as the servicing fee. This is what is effectively collected or kept by the bank, the servicer, and it's supposed to cover admin costs, admin fees, for administration of the loan pool, for administering or indeed servicing the loan pool, the pool of collateral. Plus, as we discussed in a previous video, if you've got agencies involved, like Fannie Mae, Ginnie Mae, Freddie Mac in the United States, for example, those agencies will also additionally guarantee that investors will receive their money on time. So also some element of this will be fees that are passed on to the guarantor, typically, or e.g. an agency who's involved in the whole process. Right. What I want you to, I've got a few names down which are quite important. Pass-through rate, that's very important. And up here, I'm just going to squeeze something in and then I'll expand on it. I'm going to write the term WAC, W-A-C, which stands for Weighted Average Coupon, and we'll talk about this subsequently, right, in a few minutes' time. Let me now just focus on the idea of the pass-through rate, which was down here. The pass-through rate. I had it in orange, so I'm going to use the same color here as well. This is the coupon rate on our mortgage pass-through security. So ultimately, what the investors are supposed to be receiving. Mortgage coupon rate on the mortgage pass-through. It is also referred to as the net interest a lot of the time, or the net coupon. Net, to make sure we distinguish between what the borrowers pay and the bank the servicer receives versus what they push down through the structure to the ultimate investors. Good. Now, if you take a closer look at the mortgage pool, so that collection of loans up there, it may be comprised of tens, hundreds of individual loans, right? So those loans will invariably be heterogeneous. They cannot all be the same. Heterogeneous. They will be different in terms of having different maturities, potentially. Although a lot of them have pretty standardized maturities, there will be bigger or smaller differences. They will have different mortgage rates, which are heavily a function of the credit score, the credit quality of the actual individual borrower. There will be different loan sizes, right, as well, of course. So what we have to calculate, and this gets reported to investors, is not the whole, not the coupon, not the mortgage rate and the size and the maturity of each individual loan. We report certain averages, like the average loan size for the whole mortgage pool, but we also calculate something known as the WAM and something known as the WAC. And WAC, don't confuse this with the weighted average cost of capital, which you'll encounter in other sections of the curriculum, like corporate issuers. The WAC is this idea, or this acronym up here. WAM stands for Weighted Average Maturity, and this is expressed in months left to maturity, so we can tell buyers of these instruments or the investors effectively, what is the weighted average time remaining to the maturity of loans. If they are all 30-year loans, for example, it would be 360 months. If it's a mixture of some 30 years, some 25, some 20, it will be something different. But we don't just simply do a simple arithmetic average, we do a weighing, and I'll tell you how that weighing is done. When it comes to the WAC, this stands for Weighted Average Coupon Rate, and this can be confusing because the coupon is something that we typically associate with what gets paid to investors, but not. The word coupon here is used synonymously or the coupon rate with actually the mortgage rate. It's the average interest rate or the mortgage rate paid by the borrowers, not the rate received by the investors. So be careful with this. Now, there are some examples in your curriculum of these computations. They're really, really simple. You will be given something like 3, 4, 5 different loans with different maturities and different loan sizes and different coupon rates, and your job may be to calculate the weighted average time to maturity, the WAM, or the weighted average coupon rate, the WAC. It's really simple. I'm not going to waste your time in this video to do it. Just bear in mind that the weights are supposed to be calculated as the proportion of the outstanding balance on a specific loan, how much money is left to be repaid on the loan relative to the outstanding balance on all the loans in the pool. So you have to sum up all the principal left on the loans, right? All the balance outstanding on the loans included in the pool, and see what portion of that overall sum the balance of each individual loan is. And hey presto, this is how you get the weights. And then you weigh the coupons, you weigh the time remaining to maturity, produce a weighted average. If you're feeling confused about this, have a look at the examples in your not end of chapter problems, but in the text for this topic to see how this gets done. It's really simple. It's just a weighted average. Now, more importantly, I said we would talk about different types of structures, and I just discussed the mortgage pass-through, and now I'm going to move on to the more sophisticated type of residential mortgage-backed security, namely the CMO, which, you may remember that I mentioned this, is actually built out of mortgage pass-throughs. So you need mortgage pass-throughs to create the more sophisticated structure. This stands for Collateralized Mortgage Obligation. Okay. And as I said, we need some pass-throughs first. So let's imagine we've got, I don't know, 2 pass-through structures. We've got a mortgage pool over here. That's a pool of mortgages. Let's call it number 1. We've got a mortgage pool over here. Let's give it a number 2. So this is a collection of loans, this is a collection of loans, and we may have other additional collections of loans also included, right? There's nothing magical about the number 2 here, it's just easy as an example. And each one of these mortgage pools will be acquired by an SPE. So this is SPE1, this is SPE2, and on a monthly basis, these SPEs will receive interest and principal payments, interest payments and principal repayments coming from the borrowers involved in each of these mortgage pools. The principal will be, let me stress this, both the scheduled element as well as prepayments. Prepayments feature very heavily in all of these discussions. And of course, these SPEs will pay out to investors the effect. They'll pay net interest or net coupon, or as you now know, this is also known as the pass-through rate, aka net interest or net coupon, plus principal. Once again, let's emphasize both the scheduled bit and the prepayments. Now, each one of these structures effectively forms a mortgage pass-through. So this is a mortgage pass-through number 1. This is another one. Mortgage pass through. And, up until now, in the last couple of minutes or so, I've been focusing on what happens here, on how investors receive what's known as net interest primarily, or the pass-through rate. However, which is minus all those admin fees or servicing fees. However, this time around, I'm not going to finish the story here. I'm going to assume that the investors buying pass-through securities are actually financial institutions who create a subsequent sort of higher level structure out of the cash flows that they receive. They use the cash flows from the pass-through securities as collateral or as backing for something more sophisticated known as a CMO. So this stuff will be bought not by investors as such, individual investors, but by another SPE who will take the place of investors, fully or partially buy everything up or just some bits of it, and this SPE will in turn issue bonds or securities, fixed income securities, but those securities will be broken down into tranches, tranche A, tranche B, tranche C, and so on. And this is something we've already discussed. This idea of tranching, of creating tranches, for example, in the context of time tranching, which we had a separate video on, allows for the redistribution of prepayment risk, for example, or credit risk for that matter, because we no longer necessarily all share proportionately in the cash flows received from the borrowers repaying their loans. We can now create more sophisticated rules as to the order in which that money coming from the borrowers goes to our investors who buy specific tranches. And probably the most common type of CMO structure you're going to encounter and get asked about is the not the SU, but the sequential pay, CMO. What that means is, and we've kind of discussed this on the time tranching already, is that each tranche, so A, B, C, and so on, is retired, is paid off sequentially, as the name suggests. You cannot start paying principal to the next tranche until you've already repaid the prior tranches. So there's a very nice illustration of this book, which I'm going to steal in the sense I'm just going to replicate it. It's very good, but I am hopefully acknowledging the source well. If you imagine we've got these tranches A, B, and C, what will happen is the money flowing from the mortgage pools, which gets passed from the original mortgage pass-through SPEs to the CMO SPE, as we said, is composed of two elements. Interest, didn't want to cross that out, I wanted to highlight. There's an element of interest, an element of principal. And what's really critical is what happens to the principal bits. You see, initially, it's tranche A that receives both interest and principal payments. First, all the principal that flows down from the mortgage pool to the SPEs and gets passed through lower goes to tranche A. And it's only once tranche A is retired or paid off, fully repaid, will principal start flowing to tranche B and then subsequently to tranche C. However, when tranche A is still receiving principal because it hasn't been repaid fully yet, tranche B and C are receiving their current interest. It's not like B and C are receiving nothing. No, that would be wrong to assume. Unless you've got something called tranche Z or tranche Z, which is an accrual tranche, then you do indeed receive nothing, but not in the case of more senior tranches. Right. Now, once A has been fully repaid, the money starts flowing to tranche B. But saying money is a little bit too general. Principal starts flowing to tranche B or gets diverted to tranche B because A has already been repaid and retired. So now B receive both current interest and principal. However, because their principal, face value of their securities is being amortized, it's being retired, it's being repaid, the portion of interest they get with every month should be lower and lower because you only get interest on your outstanding balance. When you were not receiving over here any principal yet, it was just interest, that interest should have been relatively constant because if you're not getting paid down yet in terms of principal, you should keep earning the same amount of interest. And the same goes for C, who still over here continues to receive interest only. Now, this point over here is when tranche B gets fully repaid because they've received enough principal, so nothing going on anymore here, and now the money in its entirety should be flowing to tranche C, both interest and principal. So this sequential payment, please appreciate, relates to the payment of principal, repayment of principal, not interest. Okay, of course, these tranches will therefore have, under this time tranching setup, they'll have different expected maturities. You can't say for certain when a specific tranche will mature and will be fully retired and repaid, because that depends on how the borrowers at the top behave, especially in terms of making prepayments, because they typically don't behave sort of in accordance with the schedule. They do prepay their loans, they look for better deals, they refinance, especially when rates go down in the market. So different expected maturities for tranches A to C, and because of that, they typically also have different coupons. There'll be coupon differentiation, and that coupon will be in line with the term structure of interest rates. If the term structure of interest rates, the yield curve, is upward sloping, so it's a normal yield curve, you may see that tranches expected to be retired relatively soon will have a lower coupon, whereas those tranches where investors are expected to stay in for longer to get their money back will have a higher coupon. But as I say, that depends on the term structure of rates. If the term structure is not upward sloping but downward sloping, it may be the other way around. And okay, some additional points here. If you are a tranche A investor, you would expect to receive your money relatively soon, or at least sooner than the other investors. So tranche A investors get protected against what we call extension risk. The risk that they will have to wait a longer time to receive the principal back. On the other hand, if you're sort of over here, down here, tranche C investor, these guys get protected against contraction risk. The risk that they'll be repaid too quickly or quicker than perhaps they want to. And this creates for a whole spectrum of different investable securities. The tranches, the individual tranches, are individual securities which are attractive for investors with different risk appetites, with different investment horizons, with different expectations about what will happen to rates, for that matter. Attractive for investors with different risk concerns, let's say. But also in a positive sense, you may want to take a certain risk on. For example, if you think that interest rates are going to drop, why not invest in tranche C? Because that will keep you earning a fixed level of interest for a relatively longer period of time. However, if you think interest rates are going to go up relatively soon, well, invest in tranche A, because that way you recover your money. You should recover your money relatively soon, which will allow you to go and take the money out and reinvest it at a better rate if you expect a better rate to be in place relatively soon. Okay, and as I've mentioned, the payment rules, the rules that kind of determine who gets money when and in what order, maybe not when, but in what order, the order, are absolutely established and known. But we do not know how the borrowers will be repaying their principal. But the monthly principal repayments by the borrowers are not known in advance. They are only known once the servicer collects the money and reports that to the investors. So the tranches, as a result, only have what we would call expected lifespans. And that makes them attractive suitable for investors with different investment horizons. Investors with different investment horizons in terms of the timing of the span of their investment horizons, 2 years, 5 years, 10 years. But you can't count on that money being received over that time frame, sort of definitely. It's all down to how the borrowers behave, which is in large part a function of what happens to interest rates. Good. Let's now talk about some other CMO structures other than this sequential pay. And there's a couple you need to know. This gets a little bit technical, and I'll do my best to try and explain each one as best I can, but within the confines, within the limits of what you actually need to know for the exam. First of all, something that I already mentioned, the Z or the Z-tranche, if you prefer the American pronunciation. This is also known as the accrual tranche or the accrual bond or the accretion bond. Accretion and accrual have very similar, or the same core to that word, so they're kind of one and the same. If you are an investor who buys the Z-tranche, we are realistically going absolutely to the bottom of the alphabet here in terms of naming the tranches. This is a very specific tranche because you receive no current interest is received. When I was drawing the previous diagrams or graphics here, I told you that the lower tranches still keep getting their current interest, even though their principal is not being repaid yet, they keep getting current interest. Well, for tranche, if this was tranche Z, this would not be the case. You wouldn't keep getting current interest Well, at least not until a specified date, after which you would receive both interest and principal repayments as well, starting to flow. Okay, however, even though you're getting no current interest, that interest doesn't flow to you as cash. Instead, that interest accrues. That's why it's called the accrual tranche. Instead, the interest kind of gets capitalized. So instead of you receiving that money, it gets added to your principal value, the capital of your investment. Instead, the interest is added, or let's say capitalized, to principal value. So the interest you haven't received in a specific month makes your balance grow, and next month the interest that accrues is already based on a higher principal value. That's the way it works, just like, you know, with compound interest in financial mathematics. Typically, this is the tranche which gets paid off, so retired as the last one. What else? The point of it is, because these investors do not receive any current cash flow until a relatively late date, it allows us to so it frees up cash flow for other tranches to be retired accordingly kind of sooner, right? The interesting thing about it, and this is, you know, a positive thing, is that there is no reinvestment risk here, because you're not getting any money until a very late date, so you don't have to worry about reinvesting it. But as with, you know, zero coupon bonds, where you don't also receive any money during the life of the bond, everything comes at the end, you face a high level of risk due to the high level of duration on these, modified duration, because everything comes in a single cash flow, maybe not a single cash flow, but everything is delayed until a very, very late time. So once again, typically, these types of tranches have average lives, your curriculum states, of above 20 years. So, you know, lots of risk here. This is risky for various reasons. Okay, so that's the Z tranche. Now, a few more. PO, or principal only tranche, and this will be coupled with something known as the IO, the interest only tranche. Actually, let me draw it maybe to the side here, because they are absolutely companions. So this is interest only tranche. Good. So, you know, when the money flows from the top, from the mortgage pools, from the borrowers, it's composed of interest and principal, the principal being both the scheduled and prepayments. Well, why not split it, not in a time fashion, you get money early, you get money later, but just say everything that's interest goes to one set of people, everything that's principal goes to another set of people. So the people who sign up for a PO tranche receive only the principal payments, be they the scheduled ones or any prepayments that may be happening, whereas the IO people receive only the interest payments. Okay, and over here it's funny because these are companions of one another. You create one and you create the other kind of simultaneously. It's a natural split. And the funny thing is to consider, or interesting thing is to consider what these people are wishing for, the people who buy into the PO and the IO tranche. If you buy into the principal-only tranche, you kind of know how much principal you'll receive over the life of the instrument. It's just a question of how soon you'll get it. Will you have to wait a long time, or will it come quick? And you probably want it to come as quickly as possible. So both of these are very sensitive to changes in prepayment rates. Very sensitive to prepayments and what's happening here, in terms of the prepayments. However, on the left-hand side, where we've got the PO tranche, if interest rates in the market go down, then prepayments pick up. The rate of prepayments picks up, accelerates. People start refinancing their loans and repaying their existing mortgages. So money flows down this whole structure to the PO tranche, and the value of the PO tranche goes up because you get the principal back sooner. You're not making any interest on this, so it's just as well that you get it back sooner than later. Better turnaround or turnover. On the other hand, if the same thing happens and you hold an IO tranche, so if interest rates go down, the consequence of this is that prepayments pick up. Lots of people will be repaying their loans early, and that will not give you an opportunity to make interest, because you only make interest when there is still some balance outstanding. So the value of the IO tranche goes absolutely the other way. And it's also important to state that with an IO tranche, nobody's promising you something fixed, like a certain par value. No, these things actually have no face or par value. And the worst thing that could happen is you invest into such a tranche, and next day everybody repays their mortgage loans, and you get absolutely close to zero interest income, and that's your problem. That would happen if interest rates dropped significantly, motivating people or incentivizing people to go and refinance their loans pretty quickly after they took the initial loan out. Obviously, this would be true in the face of no penalties for early repayments. Okay. Which exist in many markets, but especially in America, they don't really exist. But in Europe, they do. Okay, just a few more of these additional CMO structures. Floating rate tranches. I was going to write notes, but that's what you call a bond with a variable or floating interest. This is where the interest that you receive is linked to a market reference rate, like the Euribor in Europe, for example, or some other form of index. This is often, or it may be, subject to a cap or a floor, so a maximum level of interest and a minimum level of interest that will be paid on the tranche. And also, please be aware that what sometimes happens is we create inverse floating tranches. So may be structured as inverse floaters, where the interest received by investors is actually inversely related to the level of interest rates in the market. If the MRR goes up, this tranche pays lower interest. If the MRR goes down, the interest on this tranche picks up. But that, you require a bit of financial engineering to create that kind of setup. Don't worry about how it's done. Just be aware of the fact that it may come in this form as well. What else? We have something called a residual tranche, possibly. It's not as if all of, you won't encounter all of these in one setup. You'll typically have a sequential pay CMO with tranches being sequentially retired. That's what you'll normally find. Everything else here are that sort of more exotic, less common setups. So a residual tranche is one that pays out any, as the name suggests, residual cash flows. So any money left still after the obligations to the other tranches have been settled. To other tranches have been settled. And this, as you can imagine, is a pretty risky one. There may be nothing left, there may be something left. It's for investors who have an appetite and the ability to take on that risk, like hedge funds or certain long-term institutional investors who, due to their long-term investment horizon, have the ability to recoup losses over that time. It's not something that the banks would, for example, be interested in, given their low capacity to absorb risks, given the low amounts of capital that they've got. And the final one you'll be happy to know, something known as the PAC tranche. Now, this is a relatively important one, so it's a good idea to pay attention here. PAC stands for Planned Amortization Class. Okay. And it's typically accompanied by what we call support tranches. Right. What happens here is that if prepayments, remember prepayments, so the repayment of capital outside of the normal standard loan schedule is what generates cash flow uncertainty typically in these types of structures. You never know when the principal will be repaid, and there's a big risk that it will be repaid sooner than officially scheduled. However, if the prepayment levels or if the prepayment rates are within a predetermined range, not too low, not too big, kind of as more or less expected, then investors holding the PAC tranche, the Planned Amortization Class tranche, PAC tranche investors receive principal repayments according to a fixed schedule. So they effectively get a very disciplined kind of instrument which pays them a specific amount of cash flow on specific dates. This goes on over a specified, an upfront agreed, a specified period. But this behaves in a very disciplined way. The PAC investors do not feel any of the consequences of the fact that the borrowers at the top are not necessarily paying to schedule. They get their payments according to a specific schedule. So they are protected from that prepayment risk. Prepayment risk protection and effectively cash flow certainty to a large extent. Obviously, this is not guaranteed. Why? Because it only works if the borrowers at the top are keeping their prepayment levels within a certain minimum to maximum range. Even though the borrowers at the top are making some prepayments, so there are contractions and accordingly also extensions, the PAC investors or the PAC tranche is completely protected. And this is where the support tranches come in, because the support tranches are a bit, or the investors holding bonds that belong to the support tranches are a bit like bodyguards who surround the person who's supposed to be protected. If there is too much money, flowing ahead of schedule, we want to divert that money, and we don't want it to hit the PAC tranche because they've been promised a certain money in accordance with a schedule. So a lot of that money will be diverted towards the support tranche that's protecting them here from contraction risk, money being received too early. And effectively, you, kind of figuratively speaking, kill off your bodyguards, you retire this tranche earlier than they may have expected, because you divert the money towards them if it's flowing too quickly. Obviously, it's not like you tell them you've lost the money, no, just give them the money earlier. However, if the money is not flowing like we were expecting it to flow, in order for the commitment to the PAC tranche to be satisfied, in order for these guys to receive their money on schedule, we may sacrifice the support tranche over here, so they will not be receiving payments right now, so that the PAC tranche, the planned amortization class, gets received their money on time, on schedule. Obviously, whenever you get somebody to face a bigger risk so that somebody else may face a lower risk, in this case the PAC tranche is the one being protected and therefore facing lower risk, you should compensate them with higher coupons. And the PAC tranche investors will receive lower coupons. So everything that we're talking about here are ways to basically divert the payments and reconfigure the payments towards different tranches, but also adequately compensating them for the risk that they take.